All right, let's dive right in. We're going to talk about something that drives traders crazy. Why do markets sometimes look like they're about to fall off a cliff, only to just whip around and shoot for the moon? Well, the secret is all about something called liquidity. And today, we're going to pull back the curtain and see exactly how it works.
I mean, you've seen this happen, right? You're looking at the charts, you can feel the panic building. Every single thing is screaming down, 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 and then, poof, a complete 180. It feels totally random. But what if I told you it's not random at all? What if it's actually part of a plan?
So today, we're going to look past the usual indicators you might be used to. We're going under the hood to see the real mechanics at play, to really understand the strategy that causes these absolutely stunning turnarounds. To get this, you first have to know who the two main players are on the field. On one side, you've got everyday retail traders, people like you and me. And on the other side, you've got the giants, the big institutions, what we often call smart money. And trust me, they are playing a completely different game than we are. This right here breaks down the fundamental difference. See, while we retail traders are worried about getting the right info, smart money has a much, much bigger problem: their own size. They need to buy or sell massive amounts, but if they just jump in the market, their own orders will push the price against them. That's called slippage, and it can cost them millions. So, how do they solve this? Well, they solve it by being incredibly smart and incredibly patient. They don't chase the market. No, they set a trap and they let the market come right to them. Let's break down exactly how this liquidity trap gets built. The first piece of the puzzle is finding the perfect spot. They use a tool called a volume profile, and they're looking for something called a low volume node. The best way to think about it is like a quiet, empty street in a huge, bustling city. Because almost no trading happened there in the past, there's very little resistance. It's the perfect place to hide. And these quiet zones are so important because they're the ideal place to put down huge, hidden limit buy orders. It's like they're building a massive, invisible wall of buying interest right where nobody's looking. It is, quite literally, an ambush waiting to happen. And this whole strategy, it's got a name. It's called a liquidity hunt. See, they're not just waiting around. They are actively hunting for the sell orders they need to fill their giant positions. And the bait for their trap? Well, that's the panic of other traders. Okay, now for the most dramatic part of the whole plan, springing the trap. This is where the magic happens. This is where the move is made. So picture it. You're watching the screen, and you see these huge, aggressive red candles just plunging down. Prices falling fast, heading right for that quiet spot we talked about. Your gut is screaming. Everyone's hitting the sell button, and it looks like the floor is about to fall out. Just a total market breakdown. But it's an illusion. As all those traders are panicking and selling, they aren't crashing the market. Nope, they are flying directly into that hidden wall of institutional buy orders. Every single sell order is being quietly soaked up, absorbed by the smart money. This amazing moment is called absorption. It's when you see tons and tons of selling volume pouring in, but the price just stops dead in its tracks. Why? Because all of that selling pressure is being met by an even stronger invisible buying force. It's all getting soaked up. This is honestly the best way to think about it. All those panicked sell orders are just tennis balls, and that giant wall of institutional limit orders, that's the tank. The tennis balls just keep bouncing off, doing nothing, until eventually there are no more tennis balls left to throw. So what happens when the sellers are completely exhausted? When there is literally no one left to push the price down? Well, the path of least resistance does a complete flip. Now you have a huge new buyer in the market and no sellers left. The price has only one way to go, up, and it usually does it really, really fast. Okay, so knowing all this is cool, but how can you actually use this information? Let's turn this idea into a simple 4-step blueprint that you can use to try and spot these situations yourself. It's a pretty straightforward process. Step 1 is identification. Use your volume profile to find a potential trap, one of those low volume nodes. Step 2, confirmation. And this is absolutely critical. You can't guess. Use a tool like a heat map to actually see if that big wall of limit orders is there. Step 3 is execution. You have to be patient and wait for the price to drop to that level and for the absorption to kick in. And finally, step 4, the trigger. You only get in after you see that intense selling start to die down. That's your signal that the sellers are exhausted.
And if you take only one thing away from this, let it be this. This is a total mindset shift. Your goal is to stop being the panic seller who provides the fuel, the liquidity for these big institutions. Instead, you learn to spot where the real liquidity is, and you trade alongside it.
So the next time you see a chart that looks absolutely terrifying, just take a second. That scary-looking crash, it might not be a crash at all. It might just be smart money creating their own private sale, getting a massive discount, courtesy of everyone else's panic. And that's the question I want to leave you with. Once you understand the game that's being played behind the scenes, you can start to see the market in a whole new way. And what once looked like pure, terrifying risk might just reveal itself as a calculated opportunity.